One of the biggest challenges in trading is knowing when a liquidity sweep is actually signaling a reversal and when it is simply a continuation of the trend. Many traders understand the basics of liquidity analysis and market structure, but they struggle to identify the confirmation that experienced traders wait for before committing to a position. In today's video, we're going to explore the 3-candle liquidity grab reversal, an advanced candlestick pattern that can help confirm reversals after a liquidity sweep. You'll learn how to combine this pattern with ICT and smart money concepts, including order blocks, fair value gaps, premium and discount, and higher time frame market structure to identify high-probability trading opportunities with greater precision and confidence. So, if this type of content is valuable to you, remember to like the video, subscribe to the channel, and enable notifications so you don't miss the upcoming lessons. And feel free to share in the comments which topics you would like us to explore in future videos. You will also find links to our trusted partners in the description below. Using those links helps support the channel and allows us to continue producing this kind of educational content. Now let's begin with the bullish side of the 3-candle liquidity grab reversal model, and how this concept can be used to identify potential continuation after a liquidity sweep to the downside. In a bullish scenario, the higher time frame market structure is already trending upward. After creating an impulsive move to the upside, price may begin retracing lower into a key higher time frame point of interest, such as a bullish fair value gap, demand zone, or bullish order block. As the market trades back into that area, we begin watching for signs that the retracement may be ending, and that bullish continuation could soon resume. The first confirmation we normally look for is a 2-candle liquidity grab reversal. In that model, the second candle sweeps below the first candle's low, rejects lower prices, and closes back above the previous candle's range. When that happens, the reversal is confirmed immediately on candle 2. However, the market does not always confirm the reversal that quickly. Sometimes price reaches the higher time frame point of interest, but candle 2 fails to create a valid reversal closure. Because of this, I cannot yet assume that bullish continuation is ready to begin. If candle 2 fails to confirm a valid 2-candle liquidity grab reversal, we do not force the setup. We can continue observing the sequence to see whether candle 3 provides the delayed confirmation needed for a valid 3-candle liquidity grab reversal. The key difference is that a 2-candle liquidity grab reversal confirms the reversal immediately after the liquidity sweep. A 3-candle liquidity grab reversal, however, requires one additional candle, because the reversal is not confirmed during candle 2. Instead, candle 3 must provide that confirmation by closing beyond candle 2's body, suggesting that price may now be ready to continue in the opposite direction. Just like a 2-candle liquidity grab reversal, a 3-candle liquidity grab reversal should not be traded in isolation. The highest probability setups occur when the pattern forms at a significant higher time frame point of interest, such as a fair value gap, order block, supply or demand zone, or a major swing high or swing low. This occurs when candle 3 does not take out the low of candle 2, but instead closes above the top of candle 2's body. In this bullish example, candle 3 respects the low of candle 2 while closing strongly above its body, effectively engulfing it. This suggests that sellers are losing control, while buyers are beginning to regain momentum. When that happens, I can begin expecting candle 4 to continue trading higher and potentially resume the higher time frame bullish trend. This is what creates the bullish 3-candle liquidity grab reversal. The first candle establishes the reference low. The second candle fails to provide the reversal confirmation, and the third candle confirms the reversal by closing beyond the body of candle 2. This indicates that the market may have moved lower to grab liquidity before preparing for bullish continuation. Once this bullish reversal is confirmed, we can begin shifting down to lower time frames to look for execution models and confirmations for long positions, such as a bullish CISD, a change of character, or any lower time frame confirmation supporting bullish continuation from the higher time frame point of interest. However, it is important to remember that the market is not required to form either pattern. If neither a valid 2-candle liquidity grab reversal nor a valid 3-candle liquidity grab reversal develops, then this framework simply does not provide a bullish setup. In that situation, we should remain patient and continue observing price action rather than forcing a trade. Without a valid reversal confirmation, there is no evidence that buyers are regaining control of the market. Another important situation can occur when the daily chart is already trending bearish and price continues moving lower into a major swing low from an even higher time frame, such as the weekly or monthly chart. In this case, that higher time frame swing low becomes a significant external liquidity level and an area where the market may potentially reverse back to the upside. As price approaches that higher time frame swing low, we begin watching for signs that the bearish trend may be losing momentum. If the market trades below the swing low and sweeps the liquidity resting beneath it, we then look for evidence that buyers are beginning to reject those lower prices. The first confirmation could be a valid two-candle liquidity grab reversal. However, if the market fails to provide that immediate confirmation, we can continue monitoring price action for a potential three-candle liquidity grab reversal. If candle 3 closes above the top of candle 2's body and confirms the rejection of lower prices, this can provide the bullish confirmation needed for a potential reversal, or at least a meaningful retracement from that higher time frame liquidity level. Again, the market is not required to form either pattern. If neither a valid two-candle liquidity grab reversal nor a valid three-candle liquidity grab reversal develops, then this framework does not provide a valid bullish setup. In that situation, we should avoid forcing long positions and wait for new information from the market. Without confirmation, there is no clear evidence that buyers are taking control. Now let's look at the bearish side of the three-candle liquidity grab reversal model and how this concept can help identify potential bearish continuation after a liquidity sweep to the upside. In a bearish scenario, the higher time frame market structure is already trending downward. After creating an impulsive move to the downside, price may retrace higher into a key higher time frame point of interest, such as a bearish fair value gap, supply zone, or bearish order block. As price returns to that area, we begin watching for signs that the bullish retracement may be ending and that bearish continuation could soon resume. At this stage, I need additional evidence that buyers are losing momentum before considering a bearish setup. If the immediate two-candle liquidity grab reversal does not appear, I can continue watching for the delayed confirmation that forms through the three-candle liquidity grab reversal. This occurs when candle 3 does not take out the high of candle 2, but instead closes below the bottom of candle 2's body. In this bearish example, candle 3 respects the high of candle 2, while closing strongly below its body, effectively engulfing it. This suggests that buyers are losing control, while sellers are beginning to regain momentum. When that happens, I can begin expecting candle 4 to continue trading lower and potentially resume the higher time frame bearish trend. This is what creates the bearish three-candle liquidity grab reversal. The first candle establishes the reference high. The second candle fails to provide the reversal confirmation. And the third candle confirms the reversal by closing beyond the body of candle 2. This indicates that the market may have moved higher to grab liquidity before preparing for bearish continuation. Once this bearish reversal is confirmed, we can shift down to lower time frames to look for execution models and confirmations for short positions. Another important situation can occur when the daily chart is already trending bullish and price continues moving higher into a major swing high from an even higher time frame, such as the weekly or monthly chart. In this case, that higher time frame swing high becomes a significant external liquidity level and an area where the market may potentially reverse back to the downside. As price approaches that higher time frame swing high, we begin watching for signs that the bullish trend may be losing momentum. If the market trades above the swing high and sweeps the liquidity resting above it, we then look for evidence that sellers are beginning to reject those higher prices. If candle 3 closes below the bottom of candle 2's body and confirms the rejection of higher prices, this can provide the bearish confirmation needed for a potential reversal or at least a meaningful retracement from that higher time frame liquidity level. Again, the market is not required to form either pattern. Now that you understand the difference between the two-candle liquidity grab reversal and the three-candle liquidity grab reversal. Let's jump into the charts and see how these concepts appear in real market conditions. In this example, we are looking at Bitcoin against the US dollar. The higher time frame market structure is bearish, with price continuing to create lower highs and lower lows. After a strong move to the downside, price begins retracing higher into a bearish order block, which acts as our higher time frame point of interest. As price reaches the order block, we begin watching for signs that the retracement may be coming to an end, and that the broader bearish trend could be ready to continue. In this case, price rejects the area and forms a valid three-candle liquidity grab reversal. This provides the confirmation we were waiting for, and suggests that the bullish retracement may be coming to an end. Now that we have our higher time frame confirmation, we can shift down to the 15-minute chart and begin planning the execution. Using the Fibonacci retracement tool, we mark the current trend range and wait patiently for price to retrace back into the 50% level. Since we are looking for a short position, we want to see price trade into the premium zone, which represents the upper half of the current range and provides a more favorable location for bearish continuation and improved risk-to-reward opportunities. Before we continue, if you're not familiar with concepts such as fair value gaps, premium and discount, Fibonacci retracements, order blocks, liquidity, or market structure, I have a complete ICT and smart money concepts course that explains all of these topics in detail and shows how they work together within a complete trading framework. So, if you would like a deeper understanding of any of the concepts discussed in this lesson, be sure to check out the course linked in the description below. It should also be appearing on the screen right now. Now, let's continue. As price retraces into the premium zone and reaches the 50% retracement level, we place our short entry, with the stop loss positioned just above the most recent swing high. For trade management, we will use two profit targets. The first target is set at 1-to-1, where we will close 50% of the position and reduce risk by securing partial profits. The second target is set at 1-to-2, allowing us to capture a larger portion of the move if bearish continuation unfolds as expected. As we let the trade play out, price retraces into the 50% level, triggers the entry, and then begins moving lower. The first target is reached, allowing us to secure partial profits, and price eventually continues downward into the second target, completing the trade. There is another way to approach this setup that is slightly more aggressive while still requiring confirmation before entering the trade. Rather than placing a limit order directly at the 50% retracement level, we first wait for price to retrace into the 50% area, and then look for a valid change of character from bullish to bearish on the 15-minute chart. Once that bearish change of character is confirmed, we can enter the trade immediately. The key difference with this approach is the stop loss placement. Instead of positioning the stop above the higher time frame swing high, we place it above the most recent swing high on the 15-minute chart. This creates a much tighter stop loss, reducing the overall risk on the trade. Because the stop loss is smaller, we can target a larger reward relative to the risk. In this example, we continue using a partial profit-taking approach. The first target is set at 1-to-1, where we close 50% of the position and secure partial profits. The remaining 50% is left open with a target at 1-to-3, allowing us to capture a larger move if bearish continuation develops as expected. This approach requires additional lower time frame confirmation, while also providing a more favorable risk-to-reward profile. The trade-off is that the tighter stop loss increases the probability of being stopped out by short-term market fluctuations, making this a slightly more aggressive execution model. So, trader, if this video helped you gain more clarity, make sure to like the video, subscribe to the channel, and turn on notifications so you do not miss the next lessons. And let me know in the comments which topics you would like us to explore in future videos. If you want to go deeper with exclusive content, early access to videos, and additional tools to support your development, consider joining the Comlucro Trader community right here on YouTube. It's a simple way to support the channel and a smart investment in your growth as a trader. You will also find links to our trusted partners in the description below. Using those links helps support the channel and allows us to keep producing this kind of educational content. Please also remember that the mission of the Lucro channel is simple. We help traders build clarity, confidence, and structure, so every decision is made with discipline and intention. Here you will find complete courses designed as a true trading masterclass. We teach liquidity, market structure, higher time frame analysis, and supply and demand, always focused on understanding price and executing with a professional mindset. We also cover trading psychology, risk management, and long-term consistency, because trading is not just about charts. It is about mindset, discipline, and execution over time. Our main courses include Smart Money Concepts, ICT, Technical Analysis, Trading Psychology, and Wyckoff. Alongside that, we share insights from respected traders whose work helps you better understand how markets really behave. Thanks for watching, and I will see you in the next video.